You know, here's something that happens quite a bit is that a lot of you are given to charity each and every year. And as you approach retirement, you might be in very high income years over the next 2 or 3 years. And then as you approach retirement, your income might go down a little bit. Or maybe that you exercise some stock options or you got a large bonus or something like that. Here's a cool strategy that you might want to consider. This is called a donor advised fund. And so let's say that you're giving $10,000 a year. And you plan on giving that $10,000 a year to a local charity or church or whatever it is. And this year, you'll probably need the tax deduction a little bit more than next year because you have a high income year. Well, what you can do is you can bunch up, let's just say 5 years of contributions. So you take $50,000, right? So you are the donor here. And you could put cash into this thing. You could put highly appreciated stock, other assets. It goes into this fund. It's almost like a family foundation. You manage these assets. So now you have $50,000 into this donor advised fund. And guess what? You get a $50,000 tax deduction that year. Then next year you give $10,000 out of the donor advised fund. The following year you give another $10,000, or maybe you want to give $15,000 or $5,000, whatever it is. You have control on where you're giving your money to and how much that you give. But the point is that I can, as a donor, put money into this donor advised fund and get a fairly large tax deduction. Al, we use this strategy quite a bit with our clients, and it does amazing things from a tax perspective, but also it gives the client control and still be able to give to the quality charities that they love.
Well, we do, Joe, and we find this is a real popular technique if in fact you're charitably inclined. If you're not charitably inclined, then it doesn't really matter. But if you normally give to charity and you have a high income year, Joe, as you just said, maybe you had stock options that you exercised, or maybe you sold a property, or maybe this is your last year working and you're going to be in a much higher tax bracket. Those tax deductions might be more valuable to you this year, so you go ahead and put some money in a donor advised fund. Whatever you put in, you get a tax deduction. Realize there's limitations that I just mentioned, but you get a current tax deduction while you're in a higher bracket. Now, once the money goes in, it's a one-way street. You can't pull it back out, so don't put too much in. So it's going to charity and it's going to stay with charity, but you get to decide what charities get what amounts over your lifetime, and there's no minimum or maximums. You could let that thing grow 20 years, you could start distributing it right away. So it's a very, very good tool.
Right, and you can go to Fidelity, TD Ameritrade, Charles Schwab, you know, all of the major custodians in the big brokerage firms will have this, and it's fairly inexpensive. Right, so if you try to set up a family foundation, Al, I mean, you're talking thousands and thousands of dollars just to set it up, different tax returns, and there's a lot of administration headaches there. But now if you look at, hey, well, I want to take the tax deduction today, but I also want to control the assets and then dole those assets out at my choosing, this might be a pretty good option for some people, of course, if you're charitably inclined. So you want to look, do I have a high income year? And if I'm giving to charity, you can bunch those charitable gifts all in 1 year, get that tax deduction in 1 year, control the assets, and then dole them out.
Well, Joe, as you say, it is very much like a private foundation. It works the same way, except you don't have to set up an entity. It's simply an account that you set up. Very easy to do.